Hey everyone, welcome back to Corporate Decoder. Today CF4 just filed their Q1 10Q report and I see some very interesting shifts in their cash position and strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is undergoing a significant transformation and the numbers are starting to reflect a pivotal moment in their business direction. This is CapForce Incorporated, formerly known as OpGen Incorporated, and this report covers their financial picture up to the 31st of March 2026. It is a quarterly report, kind of like a checkup on how the company is doing in the last 3 months. CapForce is in the middle of a big change. They used to be in precision medicine, but since late 2023, they've been shifting gears towards financial services and technology. Think of it as a complete business makeover. They've even got a new subsidiary focused on helping international companies list their stocks on exchanges. And they've acquired a company called iCapX that manages company cap tables, which is basically a digital record of who owns what in a company. This is a pretty big deal, shifting from biotech to finance tech. Let's dive into the numbers. Looking at their balance sheet, which is like a snapshot of what the company owns and owes, we see some critical changes. For instance, their cash and cash equivalents, which is basically the readily available money they have, significantly dropped from about $531,000 at the end of 2025 to just over $78,000 by March 2026. That is a huge decrease, nearly an 85% drop. This immediately tells me they are spending money quickly or perhaps strategically using it for different purposes. On the other side, their total current liabilities, the money they owe in the short term, went up slightly from about $4.55 million to $4.61 million. Not a massive jump, but it means their short-term debts are a bit higher. One number that really stands out is their investment in equity securities, which remained steady at a massive $35 million. This is a significant asset for them, and it points to a big part of their strategy involving investments in other companies, likely tied to their new business ventures. Now let's look at their income statement, which shows revenues and expenses over a period. For the 3 months ending the 31st of March 2026, their total revenue is listed as zero. That is right, zero. They also reported zero revenue for the same period in 2025. This isn't surprising given their shift in business. They are in the process of building new revenue streams and it takes time. However, their operating expenses are where we see significant activity. General and administrative expenses, which cover things like salaries, legal fees, and running the company, jumped from about $513,000 in the first quarter of 2025 to over $797,000 in the same period of 2026. That is a 55% increase. The report mentions this rise is due to things like director compensation, costs for a stockholder meeting, and higher legal expenses. They also note that a bonus reversal in the prior year made the comparison look even more dramatic. They also reported a small amount for research and development, about $2,400 in 2026, compared to none in 2025. This small but non-zero amount suggests they are starting to invest in developing their new platforms. Because they have no revenue but significant expenses, their loss before income taxes reflects this. For the first quarter of 2026, the loss was about $710,000, a big jump from the $408,000 loss in the same period of 2025. This is a direct consequence of investing in their new business direction, while revenue generation is still in its early stages. Looking at the statement of stockholders' equity gives us insight into how the owner's stake in the company has changed. By the 31st of March 2026, the total stockholders' equity stood at about $31.2 million. This is a decrease from about $31.8 million at the end of 2025. The main reason for this dip is the net loss for the quarter. Their additional paid-in capital, which is essentially the money from selling stock above its par value, remained very high at over $301 million. This indicates a history of significant equity financing. The accumulated deficit, which is the total net losses the company has incurred since its beginning, is a massive $270 million. This highlights the long road the company has been on, making their current strategic shift even more critical. The cash flow statement is crucial because it shows where the company's cash is coming from and where it is going. As expected, with no revenue and rising expenses, their net cash used in operating activities significantly increased. It went from about $107,000 in the first quarter of 2025 to over $363,000 in the same period of 2026. This means they are burning through cash faster to keep the business running and invest in its future. Financing activities show cash from debt or equity here. They used about $87,000 in the first quarter of 2026 and about $90,000 in 2025. This is likely for repaying short-term insurance financing. The notes to the financial statements provide crucial details. For instance, the company mentions its name change from OpGen Inc. to CapForce Inc. in February 2026, which is a pretty clear signal of their new identity. They also detail their acquisition of iCap's, the cap table management company. This acquisition in December 2025 is a cornerstone of their new fintech strategy. They explain that iCap's will help companies with their equity information, making it easier for them to get ready for listing on stock exchanges and understand their value. This note is particularly important. It addresses whether the company can continue operating. They acknowledge incurring significant losses and negative cash flows historically. They are relying on financing from AI Capital, their controlling shareholder, to fund operations, and they have access to about $6.5 million more under a securities purchase agreement. They believe this will be enough for at least a year. However, the biggest story here is their delisting from the Nasdaq. They were notified for not meeting the minimum stockholders' equity requirement. Even though they are appealing this, it is a sign of financial distress and they've moved to the OTC expert market. This is a very common story for companies struggling to meet exchange listing rules. If they cannot get back on a major exchange, it severely limits their visibility and trading liquidity. Here they explain how they record their financial information. A key detail is about their revenue recognition. They primarily offer listing sponsorship and consulting services. But as we saw, they reported zero revenue for the first quarters of 2026 and 2025. This means those services have not yet translated into recorded revenue. This note elaborates on that $35 million investment. It seems they earn this as advisory fees, primarily in the form of equity in a privately held company. They are valuing it at $35 million based on an anticipated initial public offering by that client within the next 12 months. They also have a clause that guarantees they will receive at least $35 million worth of equity, even if the IPO valuation is lower. This is a really interesting and risky bet they are making. This section details their stock. They have preferred stock, Series D, where they sold 250 shares for $1,000 each, but a significant portion of the payment is still outstanding. This sounds like a deal that did not fully close as planned. They also have a standing agreement with AI Capital, their main investor, allowing them to sell up to $9 million worth of common stock. They've drawn on this and still have about $6.5 million available. This is a lifeline, but it also means potential dilution for existing shareholders if they decide to sell more shares to AI Capital. The acquisition of iCap's is described here. It was a $12.3 million deal paid for with company stock. Since iCap's is under common control with AI Capital, this was treated as a reorganization, meaning they used the existing book value of iCap's assets and liabilities, which was about $11,420. This acquisition is clearly a core part of their new strategy. This is management's explanation of the numbers. They reiterate the shift from medicine to financial services, highlighting the iCap's acquisition and the listing sponsorship services. They explicitly state no revenue was generated in early 2026 or 2025. They emphasize the zero revenue and the increase in operating expenses, particularly the 55% jump in general and administrative costs, driven by board compensation and increased legal and administrative expenses. This is where they talk about their money situation. They have about $78,000 in cash at the end of March 2026, down from $531,000 at the end of 2025. Their main source of funds is AI Capital, with that $6.5 million still available. They believe this is enough to operate for at least a year. They also mention the Nasdaq delisting again and their appeal. The cash flow summary underscores the increasing burn rate. Net cash used in operating activities rose to over $363,000 in the first quarter of 2026, a big jump from $107,000 in the prior year. This is a clear sign of increased spending to build out the new business. They are upfront saying their primary use of cash will be to fund business growth, develop their digital platform, and cover general expenses. They will likely continue to rely on AI Capital for funding until their new operations can sustain themselves, or they can monetize their investments, like that $35 million equity stake. They state their disclosure controls and procedures were effective as of the 31st of March 2026. This is standard reporting. The exhibits section lists all the important legal documents tied to this report. Now, looking at these results more broadly, CapForce is in a period of intense transformation. The financial numbers clearly show them burning cash to build a new direction, while their old business is scaled back and new revenue streams are still in development. The massive $35 million investment in equity securities is a huge bet that their clients' future IPOs will be successful. The Nasdaq delisting is a major red flag, indicating potential financial instability and significantly impacting their ability to attract investors. They are heavily reliant on their controlling shareholder, AEI Capital, for survival, which brings its own set of risks. The risk I'm watching most closely is whether they can actually generate revenue from their new services, and whether those investments in other companies will pay off. The delisting is also a major concern, as it limits their access to capital markets, similar to what happened with companies like Bed Bath and Beyond before their bankruptcy, where declining market access preceded a severe financial downward spiral. Alright, that is my take on this filing. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. Stay decoded. Like, comment, subscribe, and join the Discord.